A risk graph is a tool that gives me a visual of my potential profit and losses. This may be easy to calculate if I'm only buying and selling stocks, but if I incorporate any options into my trading, knowing how to use this tool is not only a huge time saver, but can help analyze trades and also guide me in how to best manage them. Before I start, always remember that I'm not a financial advisor. This is all just for educational and entertainment purposes only. So let's start with something simple like stocks. On a risk graph, one axis shows the price of the stock, and the other axis shows my profit and losses. If I bought 100 shares of this stock at $50, that would be my break-even point. And if this stock were to move up a buck to 51, I'd be up $100. And if it moved down a buck to 49, I'd be down $100. So that would form a line on the graph that shows for this position, for every dollar move of the stock, I'd be making or losing $100. And if I were to drag this graph out, that line to the downside would stop at zero since stock price can't drop below zero. But to the upside, in theory, price can move up to infinity. There's no limit. So that line would extend out pretty much forever, showing I have infinite profit potential. So this is what a risk graph looks like for a long stock position. Pretty simple. Or what if instead I shorted this stock at the same price with the same 100 shares? Then my risk graph would show me making $100 for every dollar drop of the stock and losing that for every dollar move up. So here, my profit potential would actually cap out because that line stops when the stock price hits zero. And my risk becomes infinite because again, in theory, price can keep rising forever, which is why they say shorting is technically more risky because I can lose more than my initial investment. So this is what a short position would look like on a risk graph. Pretty straightforward. Now let's get into some options. This is where it gets really interesting. If I wasn't familiar with options, I would check out my beginner video first, which I'll link on the screen right now. So let's say I buy one call option at a $50 strike with a 30-day expiration, and the premium it costs me is $3. So anytime I'm buying an option, I can't lose more than the premium I pay for it. So here, it would show my max loss gets capped out at $300. And since my strike price is at 50, anything below that is where my max loss starts to hit. Because my call option gives me the right to buy this stock at $50. And if this stock is trading below that, well, my call becomes worthless since you, me, and everyone out there can go out and get it for cheaper in the open market. And anything above $50 is where I can build intrinsic value in my call option. Only then is it worth something since I have the option to buy this stock for cheaper than the current open market. But because I paid $3 upfront for that option, I would need this stock to rise to 53 for me to break even. And once this stock price moves above 53 is where I would start to see profits. And just like a stock position, that line would extend out to infinite max potential profit. So a call risk graph looks like a more interesting choice because here I'm only risking $300 to essentially have the same unlimited profit potential. But here's the thing with options. Remember, they have an expiration date. So this solid line here represents my profit and losses at expiration. Because if I buy this call option for $3 right now and immediately turn around and sell it back, that option is still worth the same $3 given that nothing has changed. So I would be getting out break even. Minus commissions, of course. So with options, there's going to be a second line, a curved line that shows my profit and losses prior to the expiration date. It tells me what it's worth today. So here I have two break-even points, one for today and one at expiration. And if this stock price were to rise to 53 today, this graph tells me I'll be up about $150. But if it were to stay there till expiration, then I'd end up break even. So whenever I'm buying options, I'm paying for time. With stocks, it'll only show this one line because they don't have a time component. I'm free to hold this as long as I want. I can even pass it down to my son and he can continue to hold it and pass it down to his kids to see if it ever gets to infinity. So I'm able to sell my call option back to the market because I still have time value for this to potentially move in the direction that's favorable. And as time passes, price starts to move and or volatility changes are what makes that curve line start to shift and show my unrealized gains and losses heading into expiration. And as I get closer to my expiration date, that curve line will eventually meet with the solid expiration line. So this is what a call option would look like on a risk graph. Now, what if I was on the selling side of an option? Well, I know that sellers have an obligation. They don't have the right to choose to exercise their options like buyers do. So if I sold a put option at the same $50 strike, I'll have an obligation to buy this stock at $50. But here I'm getting paid upfront to make that commitment. So as a seller, I have a max gain. The most I can make is the premium I collect. So using the same $3 premium, my max gain here would be $300. And just like Keanu Reeves says in Speed, as long as it stays above 50, that $300 stays in my pocket. Because the buyer of this put, who's paying for the right to sell at $50, isn't going to exercise that unless price goes below that. No buyer in their right mind is selling it at 50 if they can sell it for a higher price in the open market. So just like how an insurance company gets to keep the premium collected if there's no accident that month, I can keep the premium I collect if the option I sold becomes worthless. And because I'm being credited $300, my break-even point shows up at $47. The $50 strike minus the $3 premium collected up front, and below that is where my losses would start to kick in. And remember, this line is at expiration. There's a second line that shows my gains and losses for today prior to the expiration date. And in this case, as time passes, that curved line will eventually move up to meet the expiration line. So here I can see that time is working in my favor as long as the stock stays bullish. I want time to pass so that option expires worthless. So whether I'm buying a call or selling a put, I can see both are bullish positions. But one has limited risk with unlimited reward potential, while the other has limited reward with maximum risk. So why even go for selling a put? Well, there's many reasons. One is if I think this stock is a great buy at $50 and it's something I'm going to do anyway, why not get paid $300 to do it? So if I sell this one put and it gets exercised, this would turn into a stock position. But look at my risk graph. My break-even point is at $47 versus the $50 if I just outright bought the stock at $50. Pretty interesting. So depending on the intention behind using shares and or options is when this tool can be really useful to help analyze or manage my trades. So let's take a look at an actual risk graph. Okay, so this platform is thinkorswim. This is the one I personally use for my options trading. Different platforms will obviously look different, but they should all give the same basic information. So I have some examples to go over. I actually did these trades on a paper trading account for this video because again, this is all just for fun. I think one good example to go over is my AGNC trade. So if I go into my risk graph, which can be found under the Analyze tab, I can see my profit and loss axis on the left and the stock price axis at the bottom. The blue line is the expiration value and the purple line is by default today's value. And if I just hover across the graph, at the bottom left corner, I can see the profit and loss numbers for both those lines. One shows for today's date, the other is the expiration date. Now, I can actually change today's date at the bottom here to go forward or back to see how that purple theoretical line changes as it moves closer to the expiration date. The small orange marker is the current stock price, and the long dotted orange line represents price slices, which I can set under the Price Slice tab to analyze specific price points, which I'll get into more later. And the red markers are the break-even price points. It's currently showing 4 because I have 2 separate positions in this symbol. And at the bottom, under positions and simulated trades, is where all my positions for this symbol will show up. If I want, I can check or uncheck each one to analyze them on the graph individually. I can also add orders before actually placing them to help analyze what that does to my risk graph and play out what-if scenarios. So let's go over this trade. First, I started by buying 10 long calls at the $11 strike. I paid 14 cents. So my risk, my max loss, is the premium I paid. So here it shows $140. And my max profit potential is unlimited. The stock price wasn't going in my favor and started to sell off heading into earnings. So if I did nothing, today it shows I would be down $65 or so, about half of my investment. But instead, I delta hedged it, which would need its own video, by shorting 200 shares of this stock. Why 200? Well, going back to the Price Slice tab, I can set those price slices to wherever I want, and it'll show me my option Greeks at those prices. So by setting the price slice to the current stock price at the time, I was able to check the delta on it to know how many shares I would need to neutralize the position. And by making small adjustments until I was happy with how the risk graph looked, I was able to come to the decision of shorting 200 shares. So notice how that flattened out the purple line, neutralizing the position at pretty much break even. And this new position, not only am I making money if price goes higher, but now it shows I'm also making money if price continues to fall. So heading into earnings, I was hoping this would gap huge in either direction because I'm profiting on either direction. Only if not much happens would be the worst case scenario for me because I stay at break even today. That's a pretty cool problem to have. And of course, that's what the stock ended up doing. It didn't gap, but it did sell off, just not enough to put me in the profit zone. So it's still sitting at break even today. And now I can reevaluate what I want to do next. So if I go and look at the chart, it's currently into a lot of support and the 200 moving average. So if I think this is the bottom for now, I can just check and analyze just my short stock position. Looks like that on its own is up 52 bucks. So what would my position look like if I take profit on that? So I'm going to right click and analyze a closing order on my short stock position. So if I did that, I'd be back to having just a long call position. But look at my max risk. My max risk has reduced from $140 to just $88 now. And since I still have another 3 months or so until expiration, this would be a viable option. But before I make that decision, let's set the price slice again, that orange dotted line, to my break-even point. I can do that by going to the Price Slices tab and by clicking the 3 lines on the right and selecting Set Price Slices to break even at expiration. Now notice that has adjusted the percentages on the graph along with these light shaded and dark shaded areas. These are percentages calculated from a 1 standard deviation probability. What that means is, based on how this stock has been moving and behaving, it's showing there's about an 84% chance it'll stay below my break-even point and about a 15 to 16% chance it'll be at or above it by the expiration date. This date can also be adjusted at the top here to help analyze if I was looking to exit the trade early, and I can also go down and hit the gear icon at the bottom right corner and adjust the volatility to see what that does to the probability percentages as well. So I can really go down the rabbit hole of analyzing my trade with this tool. Or I can just simply close out this trade for a tiny $13 loss right now, tap myself on the back for good management, and move on with my life. So what do you think? Let me know what you would do in the comments below. Let's quickly take a look at one more. This is SoFi. This is a pretty cool trade. I can see my max profit potential is capped out. Best case scenario, I make $1,060, but my max risk, look at that. I have no risk. Worst case scenario at expiration is I make 60 bucks. How did this happen? So I started with buying 10 calls at a $9 strike and I paid 59 cents. So my max risk was $590. And it broke out and had a nice run into resistance. But instead of selling some of the calls I already owned, I said, what if I sold new calls at the $10 strike for the same amount I paid for my original calls? So if I paid 59 cents and I go out and collect 59 cents, well, that means I would have no money tied up to this position. So that's what I decided to do, and I was able to squeeze out and collect 65 cents for those, so even better. So net, that put 60 bucks in my pocket, and the position is currently up over 700 bucks. So now I have this risk-free position, and I believe they are reporting earnings this week. So my plan is, if they gap up, then there's a chance I can hit my max gain or close to it and cash out. Or if it gaps down, I can come back to this risk graph and reevaluate, possibly closing out the short calls I have for a profit and go from there. Or if it gaps way down to zero, well, I could still pay for my dinner because I'm still cashing out 60 bucks. So as long as I know how to manage my options, this is a great tool to speed up the calculating process to see where my profits, losses, and break-even points are and try to mold that graph for the best possible outcome on every winning or losing trade. Hope that was helpful. Let me know if you have any questions in the comments below. As always, I appreciate you being here and hope to see you on the next one.